Hello viewers, in this video I'll be going over the S&P 500 ETF ticker symbol SPY. Today we are down 70 basis points and we are a few minutes away from the closing bell, and on the 1 hour chart we do see us touching the oversold RSI, and as for the 4 hour chart we still have not breached up onto positive MACD. However, we see a divergence in the 4 hour MACD, and there's some support on the 200 moving average, and there's also support if we expand out to the daily chart. We see the 50-day moving average acting as support, and since the market has not closed yet, I do want to see us close above it, and that'll be a comforting sign that this uptrend is still intact. But another argument is the 9-day moving average is diverging into the 18-day moving average, so there's some concern about this uptrend staying intact. So at the moment I do see a possible support around the price or around the 100-day moving average. Reason why: we had gapped up between, I guess it was September 3rd to September 4th. We gapped up overnight, and it looks like we may even try to fill up that gap. So that is around the price of $297 or $290.70. So if we were to move down lower, that price movement is roughly around 1.4%. And as for resistance, I do see the next resistance being the all-time high, and we were touching all-time high just last week. So I wouldn't say this will be a complete reversal immediately. Usually the price trend likes to bounce around and then head down lower, or even head up higher. But after touching all-time high, there's still a lot of confidence that the market's still intact and continue to move up. So do expect that. And if we were to move on higher, that price movement is roughly around, it is 2.3% to the upside. So let's head to the forecast model. On here, I'll go day by day, where S&P 500 will head to the next coming days. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these forecast models we should focus on? Ideally, the model that is the best match to the current trend. This is the current trend, and the model below it, I believe, is the best match, and this dates back to May 4th to July 29, 2011. So let me point out why these two charts are similar. So what we have is an average above the middle Bollinger Band, and then we proceeded to break down to touch the bottom Bollinger Band right there, and then we made a quick reversal to touch the upper Bollinger Band, and then finally we reverted back to the mean and to touch the middle Bollinger Band right there as well. And let's go to the trend in question. So what we have here is similar pattern, average above the middle Bollinger Band, proceeded to head down lower to touch the bottom Bollinger Band. Not as sharp as the current trend, but a gradual descent, and then we have an immediate reversal to touch the upper Bollinger Band right there. And in this case, we touched the middle Bollinger Band, I would say twice, but in this instance, we are closing below the middle Bollinger Band, so let me point out that. So what we have here is we have a close, several days close below the middle Bollinger Band, and we see that price action right here as well. So we have about 1, 2, 3, 4 points. We also have 1, 2, 3, 4 points. So there's reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. And back then, S&P 500 was down roughly around, I would say, 10.10, 10.10% roughly. But then again, this is a forecast model of what back in 2011 occurred, and I would take this as grain of salt that we may head lower to touch the, I would say, the gap up that I indicated in the technical analysis. And it does support that we may reach that range. So if you want this forecast model, this is available in the link below if you sign up for it, and you can use it when it's available. And that is all. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.